I guess the answer is that we pay a surprisingly little amount of attention to the national economies of anywhere, and people tend to find that it tends to divide the room when we say that, because people tend to think that the national economics are terribly important, and they sort of are, and they sort of are not. If you think about our position as a property investor or an equities investor or a fixed income investor, less so with fixed income, but with equities and property we're buying assets, we're buying companies and assets, and so as much as the background that is set by the national economics is important, we can't buy a derivative on the German property market, so we're not buying the German economy. When we're buying a building, we're buying a specific asset, we're not buying some sort of derivative on that economy. So frankly, rather say it's not, I'd rather not say irrelevant, but people spend far too much time on the demand side variables and not enough on the supply side variables for us. It's much more about the supply fundamentals at a local market level that matter to us in an economy that's generally doing okay.
I think where we're different from an Aberdeen is that we are not long-term investors. So we raise closed-end funds. These funds have a life of typically 8 + 1 + 1 years, but the deal perspective is 3 to 5 years. So we're looking to cycle in and out of any given asset or portfolio in that time frame. The shorter the better, because we're IRR focused. So we need to make sure, of course, that we've understood the general economic trends, so that when we think we're going to be cycling out of an investment, we're going to be selling into a market where there is general confidence. So it would be a pity, wouldn't it, to be selling into a market that was already in recession and where there was negative sentiment. So to us it is important. We're not economists. We buy in the economic research, and it is important to us region by region, asset by asset.